Today, I'd like to discuss about the soaring US debt, right? And is this a threat to the market? Overall, what do people think? Is this going to be a huge threat to the market? Now, why do I want to bring this particular discussion out this week? If you remember, last week I talked about would the ECB lower rates before the Fed does, right? And what are the conclusions from there? And I've also mentioned that is it if ECB were to cut its rates first, then of course you would see cut its rates for in June, and then you would see the dollar strengthen versus the euro in the short term and the medium term as well, right? So, but in the longer term, I did mention that there are a few things that could derail the US dollar growth, and that is the mismanagement of the US mounting debt concerns, and that's where I'm coming in to discuss with this, so you can understand in the short term what to do, and in the longer term what to expect of the US market if we do see fundamental changes happening to it, right? And this is one of those situation. Now, Phillip Swagel, the head of the Congressional Budget Office, has cautioned that the US could face a significant economic race if it doesn't address its growing debt. Okay. And he highlights that if interest rates rise, the cost of the US government for debt payments could soar to 1 trillion within 2 years. Now, higher debt servicing costs could lead to concerns about fiscal sustainability. So if investors believe that current trajectory of borrowing and interest rate payment is not sustainable, they might demand even high yields as compensation for perceived risk. This makes borrowing even more expensive for the government, potentially creating a vicious cycle of rising debt costs. Now, what's happening over here is that I think the world is, and the US economy in particular, is pretty used to very cheap money, okay, where the interest rates is at the lowest, and then because of that they're able to keep on borrowing and borrowing and borrowing and borrowing. Now with this high debt, right, due to this excessive borrowing and spending, and um now, when interest rate is high, it's a problem for them. And even if you were to bring the rates down, which they plan to, uh, this thing is going to balloon into something really, really big. That's why that's why I said payments could soar to 1 trillion within 2 years. Imagine that kind of issues. Now, should this issue escalate, right, it might undermine the faith in the US dollars, okay, in a longer term, because the world's main currency potentially causing a rapid drop in value. Because if you keep on printing and there's no people has no faith in it anymore, then you will see that happening. So this scenario recalls the British pound crash, and if you remember during that time, which it led to a surge in Bitcoin trades as investors sought more stable assets, right? Now, in cases where there's a lack of confidence in traditional currencies, uh, investors often look for alternative store of value. This is where assets like gold, which has a long history of as a safe haven asset, and Bitcoin, which is a newer alternative, may see increased demand. Now, during the British pound crash, there was a spike in trading volumes of Bitcoins. People sought stability outside the traditional fiat currencies. So it is not something happen out of sudden, because there is this particular halving, and then gold is simply going up because there's this war. In general, whatever's happening right now in the US dollars, right, the potential debt soaring of debt, all this adds into it, where investors see it in the long term, because at the end of the day, halving is going to it's going to go come, and it's going to go by. Is going to be an event that people are not going to talk about it until the next 4 years. The war, it can't go on forever. Eventually it has to end. But what keeps price moving up and moving up and moving up, and then the rate of dropping is much lower than the rate of rising? There must be a fundamental support behind that, right? So like things asset classes like Bitcoin and gold, traditionally not offering yields, have hit new highs, surpassing 70K and 2,000 despite a global rise in interest rates and bond yields. This trend suggests that these assets might be anticipating economic turmoil right over here, because these are not yielding assets right over here. It's only when the market perceives that it's a long-term risk coming in, that's where all the money will be pushing into these two areas. Now, if I don't want to talk much about Bitcoin because it's a newer asset, but let's just focus on gold. Gold right now, it has already surpassed the all-time highs, and it's always staying at the all-time high, right? So currently gold, like this morning, it hit a high of 2350 as well, 2350, much higher than that. So that carries a certain hint, what can really happen, what's really happening behind. So as national debt mounts, there's an increasing tendency to maintain artificial low interest rates, those adjusted for inflation, which can exacerbate the government's fiscal burdens due to high costs associated with servicing the debt. Right? In an environment of suppressed real rates, investors have historically shifted their capitals from low-yield bonds assets with the potential for high returns, such as tech stocks, cryptocurrencies, and gold, a pattern observed during 2020 to 2021. Okay, so overall, in a heavily indebted economy, which the one that we're going through right now, sustaining such low rates become crucial, even as it leads to devaluation of traditional currencies. It is what it is. They call this a new economic policy, or a new monetary, modern monetary policies, and or whatever. That these are the names for it right now. They want cheap money. They said that since Japan can last that long, the rest of the world can actually follow suit, right? Printing money and just keep on keeping rates artificially low. Now, Jerome Powell, the Federal Reserve Chairman, appears to be responding to these pressures. Right now, his commitment to lower interest rate 3 times in the upcoming months, despite a strong job market and rising inflation, suggests a strategic pivot to address America's escalating debt situation. Now, the activity in gold markets could be a harbinger of economic shifts right now. So really, monitor the gold movements and the overall developments, political developments in the US and economy as well. So if these inflows continue into gold, right, it wouldn't be surprising to see Bitcoin gaining similar momentum, whereby this asset class could break the 6-digit mark in the coming months. Okay, because it's already done movements that has surprised everybody already. We have had the new highs being made even before the halving, and that's never happened before. So we shall wait and see does this new movement, a new high before halving, translate into extremely bullish momentum for Bitcoin and the cryptocurrency in general. Okay, so that's the end of the report, fundamental report for today. Let's move on to the charts.